Okay, Assalamualaikum and good day everyone. Okay, so I'm going to actually discuss an example of parent company, subsidiary and associate. In this simple example, the parent company and subsidiary account has already been consolidated. Because the target of this question is actually to show you how associate company fit into the equation. Okay, so okay. So in this case, okay, if you read the question, set out below are the draft of parent company and its subsidiaries and of associate company. Parent company acquire 40% of the equity capital of associate company 3 years ago when the latter reserve stood at 40,000. So the pre-acquisition reserve is actually, this is actually the pre-acquisition reserve. Okay, okay, so what we do is we know that P holds shares in S. The assumption is there are no controlling interests. It means that 100%. If you look at the notes, if you look at the notes, no non-controlling interest. Okay, 100%. So in A, 40%. Okay, so during this the acquisition, the pre-acquisition reserve stood at the pre-acquisition reserve stood at 40,000. Okay. So now we are going to prepare. You are required to prepare the summarized consolidated accounts of parent company with some notes. One, assume that as the associates liabilities are stated, assets and liabilities are stated at fair value. Second, assume that there are no non-controlling interests in the subsidiary companies. Okay, so if you can remember, so this is actually the format. Okay, so the format of okay, the format. Okay, so you need to add everything. You need to add for group to be consolidate. You need to add parent and subsidiary. However, not associate company. Okay, so if you look at line by line, sales revenue, cost of sale and administrative and interest receivable and interest payable is add up across the board. Okay, which comprise of P and S. And then you will arrive at a net profit. So so after net profit, you will, to account for associate company using equity accounting, you will take the, okay, so the profit after tax of associate company times share owner. Okay, so this one. Okay, times percentage of shares owned. Okay, and then you will derive with profit before tax, and then minus income tax of the groups, and you will get profit after tax. Okay, so this is actually the format. Okay, so in this question, okay, If we start with consolidated statement of profit and loss for the year ended, they haven't stated any the year, so we just put for the year. Uh, Start with profit before tax. Okay. Okay. So we'll start with net profit. If you remember the format, we start with net profit and then share of profit of associate. Okay. So start with net profit. Net profit. In this case, you just take the parent and subsidiary, 95. And then only you take account of share of profits of associate companies. In this case, this figure, net profit after tax of associate company, 50% times percentage of share, which is 50,000. 50,000 times 40%, which is 20. Okay. So you add 95 plus 20. So it means that now you have already taken account of profit of associate using equity accounting. So this one is called profit before tax. Profit before tax. Okay. And then you deduct income tax expense only. Take only the parent and subsidiary. So income tax expense. Income tax expense. Okay. Because you already take the profit before tax, it means that for associate company, it means that you have already taken account of the tax. So now you only, for income tax expense, you only take the income tax for parent and subsidiary, which in this case is 35. And then you will have a profit attributable to the shareholders of parents, which is 80. Okay.